Couple more weeks of tax season. So for today's video, we're going to talk taxes. Specifically, the two tax changes that I'm keeping an eye on for my clients this year. I'm Jack, the owner of JRO Wealth Management, and I help you manage their income taxes and investments throughout retirement. And the two changes I'm looking at are the enhanced senior deduction and a higher state and local tax deduction. Both of these came about last year, actually, through the One Big Beautiful Bill Act. And we'll dive into more details in just a moment, but a quick technical note. Your ability to take advantage of either of these is impacted by your income. If your income is too high, then you're going to lose out on some or all of the benefit. Here's the technical part. The way we measure income is very specific. And rather than just get into the details on that in the video, I'm going to write about in the description and a blog post. So for this video, I'm just going to say income, and I'll also flash on the screen what that specific type of income is, just to keep it simple because there's enough going on here. And with that out of the way, let's look at the first change. The first change is the enhanced senior deduction. Here's what it is. If you're at least 65 years old and you meet the income limits, you can take an additional $6,000 deduction on your tax return. And if you're married and you're both 65, well, just double that then. So it's $12,000. It's in place 2025 through 2028, and it actually sits on top of your standard deduction or itemized deduction. Doesn't matter which one you do. Here's what this actually looks like in practice. So if you're single and you're at least 65 years old, you have a base standard deduction of $16,100. And because you're 65, you get an additional $2,050. And with this new deduction, the enhanced senior deduction, since you're 65, and if you meet the income limits, that's potentially another $6,000. What about if you're married? Well, your base standard deduction is $32,200. And if you're both 65, you get an additional $3,300 on top of that, regardless of your income. And if you meet these income limits, then you get the enhanced senior deduction of $12,000. So depending on your situation, if you're single or if you're married and you meet the income limits, that could potentially be $24,000 or $48,000 of tax-free income. That is important to know for planning purposes. Those are things that we want to take advantage of. Okay, so what are the income limits then? If your income is below these amounts, then you're eligible for the full deduction. If it's higher than these amounts, then you're not going to get any of the deduction. And if it's between these amounts, then you'll get some sort of the deduction. Essentially, the higher your income goes and the more it reaches that ceiling, the less of the deduction that you're going to get then. Here's where we want to keep an eye on this for planning purposes. Classic example, Roth conversion. So you're moving money from an IRA into a Roth IRA. You're choosing to take money out of the IRA now and pay taxes on it so you can get tax-free income later on. If you're doing a Roth conversion, typically people have a goal of saying, hey, I want to fill up the 12% tax bracket. I want to fill up the 22% tax bracket, because you know how much tax you're going to pay then if you stay in that bracket. But with this new deduction, there's an additional wrinkle in place. Because if you make your income too high, not only are you paying tax on that conversion, right? But you're actually losing out on the deduction. And if you're losing out on the deduction, your tax bill will be higher. So you're getting hit from both sides. Higher income, lower deduction, and you get higher tax or both of them then. So that's the key takeaway here. Suddenly tax planning opportunities like a Roth conversion could become more expensive. Doesn't mean you shouldn't do them, but it's just something to keep in mind. The second change is a higher state and local tax deduction ceiling. Back in 2017, the Tax Cuts and Jobs Act actually made the ceiling $10,000. So even if your state and local property taxes and income taxes were higher than $10,000, you couldn't deduct it. Now the ceiling is at $40,400, and it will increase each year through 2029 until 2030, when it drops back down $10,000. Now, in order to take advantage of this, you have to itemize your deductions. And we just saw how high your standard deduction could possibly be with the enhanced senior deduction on top of it. So it's a really high threshold in order to cross for it to make sense for you to itemize your deductions versus standard deduction. But maybe this flips the script for you. If you're in a high income tax state or a high property tax state like California or New Jersey, New York, maybe it makes more sense for you to itemize your deductions now. And if you're in that boat, you want to know the income limits. If your income is lower than this amount, then you can go ahead and take advantage of the higher ceiling. If it's higher than this amount, then the ceiling actually drops back down to $10,000 for you. And similar last time, if it's in between these two amounts, then you'll get some portion of that ceiling. It'll be between $10,000 and $40,000. And here's a quick example of how we can see this play out. At the end of last year, I'm helping a client make some changes to her portfolio. She's self-employed, high income earner, and she's just beneath that threshold where if she were to cross it, suddenly that ceiling starts to decrease. She won't be able to deduct as much of her state and local property taxes and income taxes. But if we made all the changes we wanted to, well, we will have incurred so much gain. We will have gone over that threshold. So we will have increased our income and also decreased our deductions, leading to an even more expensive tax bill. So really easy. All we did, we just made some changes in last year so we don't cross that threshold, and we'll make more changes this year. And that's really all we're doing with any sort of planning. We just want to be aware of what is the tax impact going to be before we make the changes. And if it becomes more expensive, that doesn't mean we shouldn't do it, because everyone's circumstances are unique and your goals are unique. You just want to be aware ahead of time of what it means for you, and you don't want to miss out on these deductions if it's going to make a material impact to your situation. And if you want to see more educational videos like this and case studies in the future, go ahead and hit the subscribe button. Take it easy.